well placed, to be honest.
Within six months, we are going to cash flow positive.
Sweet spot of the price is between 15 lakhs and 25 lakhs.
The downside momentum for our markets continue for the fourth day in a row. The key will be, can HCLTech up its guidance?
Rupee buys less, obviously everything falls, and that's what we are witnessing at this point in time.
The markets are showing no signs of respite whatsoever.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
It is a slam dunk. The market is down on the Nifty more than 300 points. And, there was some semblance of a recovery mid-session, but all that is gone. It's both rupee and stock markets, one feeding into the other. We don't know what is leading, what is lagging, but both are pretty much at the low points of the day. This is Closing Bell, last hour coming up. I'm Prashant. With me, my colleague Surabhi and Reema here in the studios. Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. And folks, not that any of you needed any more bad news, but I was looking at US futures right now after dropping on Friday. It's not like they're offering any semblance of recovery right now. Europe is down 0.5%. Asia has been down. We're in step with Asia. But US futures, NASDAQ futures, like last time I checked, were down almost 1% again.
Well, indeed. And, the November lows got taken off earlier in the trading session itself. So things looking a little bit iffy as we speak. And the problem is any kind of bounce is getting sold into the broader markets. That's the real pain point. 180 stocks advancing with more than 2,000 stocks declining. Portfolios are hurting today.
No, absolutely. And I think you've got quite a bit of sort of pressure, which is coming up there at this point in time. Okay, I think I'm not sure what that number is. If you can have the Nifty up, we're down 300 plus, right?
Yeah,
315. So the 200 number. That is from the days high. Okay, that's the number. 320 points from last close. So yeah, 23,112 is where we are. Let's just put the rupee up as well. And I think that is, of course, also another factor. Maybe the bigger driver, what is leading to this slight sort of panic, if you want to call it that, a 0.6% fall, 50 paise depreciation in the rupee in one single stroke, in one single day. And that is, quite remarkable. So 86.51. The rupee, remember, for the last couple of years, also the point is that we're not used to big moves in the rupee because for the last 3 years, 4 years, the dollar rupee has been the most stable, predictable, boring currency pair in the world. And it's kind of being let go a little bit here on the downside over the last couple of days. Some chatter also in the market, maybe not chatter, but acknowledgement that under the new under the new governor, they're kind of a bit more, they're letting the currency depreciate a bit more, and maybe the right, for the right reasons, because this is a big dollar tide higher and not something against which you really want to spend precious dollars defending the currency against. So that's going to be a big talking point over the course of the next 60 minutes or so. No point really looking at this stock or that stock, this sector or that sector, because it's largely all kind of this broad top-down macro-ish sell-off. Which markets are facing at this point. So 23,100, 300 points lower as we begin the last 60 minutes this Monday afternoon.
Hi, and the dollar index high today was 109.98. So we almost got to that 110 mark on the dollar index. As Prashant said, there are hardly any spaces of green, but there are 4 Nifty stocks with a green tick, none more than 1%. You've got Axis Bank up nearly 0.8%, TCS, Indus Bank, and HUL. These are the only spots in the Nifty out of, which are in the green. 46 of the Nifty 50 are in the red, and the cuts go deep. Adani Enterprises down 6%, Trent down 6%, BEL, Adani Ports, oil marketing companies are getting hit hard. Power Grid, Apollo Hospitals, there's literally no space to hide. And look at the broader markets. The midcap index is now down 2,200 points. It's more than a 4% fall. The pain is running deep. The advanced decline ratio stands at 1 stock advancing for 12 stocks declining.
2025, it's really been painful for the broader market. The Nifty is down 2.5% in January so far, the number of trading sessions that we've had. The small cap index, that's where the unwinding is happening. It's painful, excruciating, 10% down. on the small cap index so far in into this year, and about 8-9% down on the mid cap index as well, because that is where the real pain and the real hurt is. We'll talk about this as we go forward. We've got Hormaz, who's been looking at a lot of the inner gory details of this mid cap and small cap fall. We'll get to it as we go along. But for the time being, let's talk about how we should be positioning ourselves in trade for for this last hour. We have Mitesh joining in. Mitesh, this has become a trending down day. So, I mean, if you leave emotions aside, if you're looking at it like a trader, there could be money that is to be made on the way down also. Are you keeping any shorts open?
In fact, we kind of covered it. We had some bear spreads on the index and some short positions. It is also extremely oversold. We don't know whether, when these stocks are falling a bit far from their moving averages, pivot points, whether it's good to be in the short side of the market. So waiting for a bounce back to play into, but the structure remains weak now. If somebody has shorts, I think a trailing stop would come at 23,325 on the Nifty spot, which was the earlier low. As long as you're below that, don't look for a recovery or a pullback. And hence, I think around bounces around to those levels would be shorting opportunities. But again, as I said, I think it's oversold. So shorting right now may not be the best idea. A bounce back is a better point, because if you short a 200 point bounce back, let's say around 270 or levels, you have a 70-80 point of stop to take. There's a supply pivot over there. So that is a better entry point. I think, instead of shorting at any level and then getting wiped off in a pullback, you may not be able to make money on the downside, which is pretty okay. You just sit put. Wait for the risk-reward ratio to be in your favor, and then then pull the trigger.
And stocks, Mitesh, individual stock strategies, anything for the last hour?
So on the stock side, still, there's some possibilities of taking short positions, and recommend a Kotak Bank, again, keeping a very tight stop at 1755 here. Looking for a target of around 1700 to begin with. Maybe slightly lower, but yeah, that's the broad target area for Kotak Bank. And similarly, L&T Finance is something which can be shorted with a stop at 134.5 for targets of 122.
Okay, all right, Mitesh, we'll keep coming back to you over the next 60 minutes as we track this, sort of panic in the market, correction that we're seeing. Lakshmi Iyer is with us, CEO of Investment and Strategy at Kotak Alternate Asset Managers. We want to talk about the rupee. Lakshmi, good afternoon. Good to have you. These are very large moves that one is not used to, essentially, right? The dollar-rupee pair has been so remarkably stable and predictable and boring that this is exactly the opposite of those three things. So just your thoughts of what's going on and where are we headed near term?
No, absolutely. These are not the best times, and obviously not a great start to the year. Given the fact that, if you look at the foreign portfolio outflows, the year has begun where the net sales in equities and fixed income both are negative, to over $3.5 billion negative. And this comes at a time, not just dollar is gaining strength versus every other currency, including rupee, but also U.S. Treasury yields rising. So I think it's a little bit of a bummer situation to our mind, which can probably extend for a little bit more so I don't think, are we yet stabilized in terms of the market conditions? I think the answer to that is clearly not.
Lakshmi, hi, afternoon. Are we seeing limited intervention in the currency market? Any evidence of that? And secondly, does the rupee price out any potential rate cut in the upcoming policy meet?
So honestly, if you ask me, if you on the rate cut part, if I tell you right now, seems to be, it is needless to say, it has to be on the back burner for now, for two key reasons. One is the US is not going to be in a pressure to ease interest rates anytime soon, given the jobs data, etc. Second is, if you look at the rupees, if you look at it as a basket of all other currencies, it's clearly indicating reasonable overvaluation. And you wouldn't want to, probably ease interest rates at the current juncture and cascade, or kind of exaggerate the pain on the currency right now. So I think from all those perspectives, I think it's fair to assume a delayed rate cut cycle in 2025.
Lakshmi, I'm just trying to be, hi afternoon, this is Surabhi here. I'm just trying to be an optimist in this rather negative, somber environment. All this has happened. Markets are so rattled even before the real tariff announcements begin. by Mr. Donald Trump, right? The dollar index has rallied 6-7% in just 3 months. I mean, in October, we were at 101. Now we're almost touching 110. So could the silver lining be indeed that this whole thing is now just about to peak out? And that when the actual announcements come, even if it is 10% tariff or 30, 20, whatever the announcement is, the market remains, a little unfazed because, well, it's already gone through the pain. Or no, I'm being too optimistic.
No, Surbi, I think more than optimism or pessimism, I think the time right now is to, display some pragmatism. I'll tell you why. You look at crude oil prices, one moment we can say too much of Trump mania getting priced in, but look at crude oil prices. I mean, they clearly will put further pressure on our country's trade deficit. So today, if the dollar is behaving like the Mufasa of the market, I think it is with every reason. So I think one needs to probably, lie low in the very near term. And these are all near-term constraints that I'm talking about. The broader narrative of the macro does not really change. But I think near-term, given the fact that if you look at the last 12 months, our currency depreciated the least or among the least, some payback or Guru Dakshina or currency Dakshina, I would say, is inevitable, frankly.
Lakshmi, last, you look at 5 years, 10 years, every year, there's about a 3.2% average depreciation in the rupee, right? Last year also it was something similar. It's just that we've started this year and it's a big move coming very, very quickly, right? That's it. Now, if all what we're saying, I mean, oil remains high and maybe another rate hike in the US, as some are calling it, then maybe the pressure sustains. But one could also take the view that maybe, once Trump comes in, his basic agenda is tariffs, of course, but also lower energy prices. You think, oil is a big one for India, as we're a large importer. And, the view also is that ultimately they're going to be pragmatic. Every day, Mr. Trump, at least when he was president from 2017, he used to wake up, look at the Dow and marvel at how high the Dow was, right? He doesn't like markets down. And he's certainly not aiming to crash markets. I mean, do you think this is in a way sort of, sell the rumor, not buy the fact, but something similar to what Surabhi said? Maybe we peak out around that time. Or you think it's unlikely?
Yeah. No, I would say that, if bad news is traveling, it has to travel the elevator and good news can take the stairs. So it's good that some bit of this, bad news is actually getting priced in sooner than later till we start focusing on the slightly better stuff. We are not rooting for a U.S. rate hike in the near future. At least that's the view that we still maintain. But yes, gratification for rate cuts, which the markets have been waiting for a fairly long time, starting this quarter, I think that clearly needs to be behind the back burners. So yes, bulk of the negative news is getting priced in right now, but it's more of a wait and watch.
Lakshmi, we all used to talk about the Fed put ultimately during the global financial crisis. That there's a Fed put, and when will it come to play? I'm just wondering if there's a Donald Trump put somewhere at some point in time, and the markets can ultimately hold on to that, final hope for some sort of deliverance. But thank you so much for joining in. We're in interesting times, and we look forward to more conversations as we go forward as well. So that's the global backdrop, and we're sort of mere spectators, both in the currency market and in the equity market right now with the kind of FPI selling that we have seen. So yeah, waiting and watching till the 20th.
Somebody was joking and saying, what is the most beautiful word? What is going to be the most beautiful word in 2025?
I don't even want to
focus
guess.
On the word beautiful. It's beautiful. I mean, who says beautiful at least 10 times and this is Trump, tariffs.
I don't know if beautiful is a word that our equity or our currency market will go with right now. But yeah.
It's, a lot to watch, right? 20th, of course, is a week from now, essentially, is when the inauguration is. And, we'll see where we are. Are we around these levels by then or maybe even a little lower? But, you're going into the event with a fair bit of selling already. That is, but you've got to go through the pain. You've got to get through day by day. But let's just step back and take stock of how much markets have come off, right? I mean, for the Nifty, Bank Nifty, mid-cap, small-cap, as of Friday, from the all-time highs, respective all-time highs, we had given back approximately equal, 10%, 10.5% or so But let's look at stocks as well, and how much of stocks fallen. Hormuz is here, and he's run that screen. Hormuz.
Now, the screen is definitely not beautiful, and that's not definitely the word of today's session for sure. But we spoke about the broader market sell-off on Friday, and we are just broadening the horizon today and speaking of the Nifty 500 in general and trying to map the 500 stocks on that index. Coincidentally, the all-time high on the Nifty 500, 24,573, on the same day, the 27th of September 2024, is when the Nifty made its own record high of 26,273, and from there the index has corrected almost 13%. I'll run you through some numbers then. Over 20% or more, at least a third of the index, or at least 180 stocks are down 20% or more from that level, and barely 10% of that index, or not even 10 actually, only 29 stocks are gaining more than 10% since that peak on the 27th of September. So which are the top losers then from that day on the Nifty 500? Adani Green Energy has halved. Honasa Consumer has almost halved. PCBL, after the rally that it saw between July to September, has come off, and come off how? Down 40%. Inox Wind, HFCL down an equal quantum. The list does not end there because the list is a long one. There are some other names as well in this. Chennai Petro 37, MGL, Godfrey Phillips, IndusInd Bank, the worst Nifty performer of last year, continuing to move downwards and down 35% from that level, as is PVR Inox. So these are some of the big movers on the downside from the 27th of September. Is it all gloom? Well, not really, because there are some gainers as well in this list, and those are the ones that are bucking the trend. Amber Enterprises is one of them. Lloyds Metals, BSC, and Vijaya Diagnostics makes an entry here at 37% higher from those levels of 27th of September, as is CRISIL. But mind you, even if these stocks are up 30 to 50%, they too have come off anywhere between 10, 12 and 15% from their own respective highs. So the gains are trimmed, but there are gains nonetheless. But the screen is specifically skewed towards the downside. At least a third of the Nifty 500 is down 20% or more over the last 4 months.
Thank you very much for that. Dipan Mehta of Elixir Equities is now with us on the show. Dipan, what's happening? And what are you doing, in terms of your portfolio? Are you still hands-off, waiting for markets to fall some more, or is it time to start buying?
Good afternoon, Rima, and thank you for having me on your show. I think over the last several months, I've been advocating caution, and therefore we have taken a slightly cautious view. We are sitting on cash and advise the same to our clients as well, but not yet got into the buying zone. I think we're entering into a very interesting earnings season. And as and when numbers come out, you would like to analyze them, study them, and then pick and choose and then buy. I think we are in for a long haul or longer period of correction. This correction is very different from what we have seen over the last 4 or 5 years since the COVID recovery. And I think it's going to be a bit long drawn. And investors will have a chance to buy at their prices and at their, I would say, at their preferable time period. So I think better to just wait and watch, and let's see how the market evolves.
Okay, all right, Dipan, stay with us. Avenue Supermart, that's stock in focus. The company reported a disappointing set of numbers in the third quarter. Mangalam joins us to fill us in with a quick analysis on that one. Mangalam?
There are two reasons why DMart stock is under pressure in today's trading session. The first one is that despite an 18% revenue growth that the company reported, which was a positive surprise, the margins were actually lower than street expectations on account of a couple of factors. The gross margins declined by 20 basis points. The operating expenses as a proportion of sales increased by 20 basis points. And also the employee expenses increased by 20 basis points, causing a 60 basis points decline in EBITDA margins, and the net profit being below street expectations. The second reason why the street was disappointed or negatively surprised was this change in management that was announced along with the results as well, where Neville Narona, the CEO and MD of the company for over 2 decades, had decided not to renew his contract, which ends on 31st January 2026. And thereafter, there would be a leadership transition where Anshul Asawa of Unilever, currently the country head of Thailand, joins in the company as CEO designate, and thereafter will succeed Neville Narona come February 1st, 2026 itself. The reason why the margins were lower this time around, the company attributed that to increased competitive intensity in the consumer space. Secondly, the number of stores that they've been adding, so operating leverage and the investments that they're making in DMart Ready as well. And third most important is that the category mix still remains stable at around 23% for high margin apparel and general merchandise business itself. Looking at all of these factors, brokerages have pared down their EPS and earnings estimates, and as a result of which some of the target price revisions have also taken place on the way down. That explains why DMart is lower in today's trading session despite an 18% jump in revenues.
Thanks a lot for that, Mangalam. Well, Deepan, what's your view on this name? It made a lot of wealth for people who held on from the IPO onwards, but from the top it's pulled back big time. At one point of time it was a good candidate to get into the Nifty, but after this recent fall, its free float actually has come down dramatically. So it doesn't stand a chance as of now. Your view on the happenings, the weak results, and the change at the top?
Yeah, Nigel, good afternoon. I think it's a reflection of the kind of competition which is there in the space. And investors perceive that DMart doesn't have a kind of a credible response to the quick commerce. And rightly so, I think it's a conservative company. It focuses on bottom line. It doesn't focus, its strategy does not include burning up a lot of cash the way some of the quick commerce companies and their competitors and their challengers are doing at this point of time. So it prefers to go on a slower growth rate rather than burn cash, which is perfectly fine. Who knows who the winner will be in the end of the day. But for the time being, I think it is facing intense competitive pressure, and that's visible in the operating profit margins as well. Just one more aspect on the DMart numbers. I think a lot of the decline in the net profits is also because of lower other income. So I think that in terms of operating profits and operating profit margin, it was stable. But I think the other income has got hit over there. So that's just a kind of observation that I like to mention.
Right. Got that. Deepan, by the way, when markets correct like they are correcting now, and there is an event like the budget, suddenly the budget assumes importance. And everybody will start looking at how maybe there is some help which is required, and whether we had Rahul Chadda in the morning with us. He was saying that he thinks it will be a market-friendly budget. Market-friendly, of course, means expansionary, some more spending. You think that will be the case, Deepan? Any thoughts?
No, I think only thing we can expect from the budget is there's no change in taxes, especially for the capital market, because other than that, there's no real expectation from the budget, and they will keep on increasing the expenditure, whether it is revenue or capital. But on the ground, you need to start spending before the effect starts to take place. I think the most important event in the market is January 20th, when President Trump takes over, and what happens a few weeks after that, and this particular earnings season and RBI policies.
One thing I think one can say that markets underestimated Trump winning, right? Markets underestimated, but I don't think they're underestimating his policies because, especially looking at how forex and rates market in the US is behaving and emerging market currencies, etc. as well now over the last couple of days or so. Deepan, anything else out there? You think finance companies, etc., in this kind of an environment maybe take a harder knock as compared to the rest? NBFCs largely is what I'm referring to, not larger banks.
Prashant, I think everything is falling, and NBFCs also will correct along with that. But I think NBFCs are in a decent shape, except if you're doing microfinance. So other than microfinance, NBFC, I think largely the sector is doing pretty well, and the NPAs have not crept up as much. And they have been, I would say, conservative when it comes to the lending. Valuations are extremely attractive, and base effect will come into play for these companies. So I think that banks and NBFCs may be able to report slightly higher earnings, and that could be, I think, one space which may outperform. But Prashant, on another note, we keep talking to technical analysts, and I see the charts very little. But I think the formation of what we called is a death cross is happening, where the 50-day moving average is not going to go below the 200-day moving average. And although I'm not a technical analyst, I think that's one very important indicator which I always track. And that's something I think which is causing a lot of at least concern at our end over here.
Yeah, I know. I mean, the nomenclature is such that some of these technical patterns and terms you can't help but not be curious about, like the death cross, like you mentioned. There's something called the hangman as well, or the hanging man, if my memory serves me right. But anyway, Take that point, Deepan, completely. The question is, in a market like this, what do you do? Where do you hide? And also, let's try and be a little rational and pragmatic. I mean, it's markets finally put on a sale. You're getting prices, but I think a lot of people are hesitant in anticipation of lower levels. I think there's also a fear of deploying right now because you don't want to see then your portfolio down another 5, 7, 10%. So how would you start deploying? Where would you be in the market? Give us 1 or 2 specific ideas.
No, I'm not giving any idea. All through this interaction, I've been saying I want to be cautious. I want to wait and watch. I want to see how the earnings season actually rolls out. So I'm not giving any ideas. But I'll tell you one thing which I did notice. I think just dial numbers are very good. I mean, if you want to take it as an idea. So I'm going to watch the market, and some outstanding businesses will be available at reasonable valuations. Platform companies, solar equipment manufacturers, something on the EV side. The capital goods manufacturers, high-tech manufacturing, businesses which would never buy in a bull market. If you have a list like that ready, and I don't have a list, I'm in the process of preparing it. If you have a list like that ready, and then you have a particular price point or a P multiple point when you want to enter, that may be a good strategy, because, these are kind of correction markets or bear markets, whatever you may call them. And they will also turn in a few months or quarters, one can't say. But if you have cash and you want to deploy it, then I think it's best to deploy it in good quality businesses, which you can otherwise not get in a very bull market. Like supposing the business you like, which was earlier trading at 50, 60 times, 70 times P multiple, and suddenly because of correction and higher earnings in this particular quarter, it's available at 35, 40, 50 times thereabout. That may be a good entry point if you have a long-term kind of a horizon to hold these stocks.
See, Deepan, that's why I'm pushing you. I'm trying to fire up the animal spirits, right? Even in a declining market, trying to keep the mood up. So you're saying that you're drawing up that shopping list, and maybe Just Dial could be on it. That's the one name?
Disclosure,
Okay.
we and our clients are invested in it. And
already invested.
Like the business model, I think the numbers are very good, although it's not reflected in the stock price per se. There could be some disappointment on the qualitative side. But nonetheless, it's a solid compounding business. So, I'm quite optimistic on it. But you need to have a longer term horizon over here.
Okay, all right. Thanks a lot for that, Deepan. Should we try to push you for a couple of names, Just Dial, and we'll wait for that list that you're going to be drawing up. Thanks a lot for joining in. Well, by the way, as Deepan was making that point, a few stocks have recovered from the day's low. Inox Green, pull up the intraday chart out there. Big recovery from the low point of the day. Volumes as well picking up. Rosari Bio, that's another one that's seen a big uptake in the last few minutes. So maybe it makes sense to pull up a couple of these names. And V-Guard Industries as well. That's another one that's recovered. Remember, the breadth of the market is absolutely under pressure. But a few of these names have come off the low point of the day. And from the frontliners, HUL is one stock, big underperformer. Even if the markets were in, in good momentum. But that one in the last few minutes, from the red train, it's moved into the green, as is the case with HCLTech, which comes out with a set of numbers in the next couple of hours. Well, it's a good time then to get in Nimesh to tell us what he's picking up on D Street Chatter. Well, Nimesh, any bulls left, or it's mostly bears?
Well, it looks like it's mostly the bears. And actually, it's more of a macro sell-off. The way the rupee is at, dollar rings at 110, rupee above 86, crude at back to 81. That's having a big impact on the broader market stocks, and that's impacting the sentiment as well. Look what's happening to the broader markets. Last week, the index fell almost 6-7%, and again today, the midcap index is down 3%. So 10% shaved off in a week. And the individual stocks are down 20, 30, 40%. So that's the kind of hit we've seen in the portfolio stocks for many investors, and that's having an impact as well. Sentiment also, there's a bit of impact now. From a domestic flow point of view, Nigel, the feedback is while they have been nibbling into the broader market stocks, the mid and small cap, but it's very slow and very nimble. So they are not in a rush to buy because they are also aware that you can see further sell-off. And you might get 4%, 5%, 10% lower. So there is buying in the broader market from DRs, but it's very, very slow. From an FI flow perspective, while they've been sellers in the market, it's not that large, which is showing up in the broader market. So it's more like on the Nifty there is selling, but that's matched by the domestic buying as well. I guess might be close to the bit of a bounce back in the Nifty. I'm not too sure about the broader markets because all the stocks have rallied so hard in the last few years that maybe there could be more pain, and there is so much of retail and institutional participation which is still there in the broader market stocks. So that's the overall feedback. I guess we've broken the crucial support of 22,300 on the Nifty. I've been saying this, that's a very important level to watch. Now the next level to watch is 22,800 to 29,900 level. So that's the next technical level which a lot of analysts are talking about. But broadly, I guess the pain seems to be much, much higher in the broader markets, and that's largely because the non-institutional investors are now throwing in the towel.
All right, Nimesh, I'll be waiting by in the next few days to hear out when you say that now those non-institutional, market players, they're feeling a little bit better because there is clearly pain just looking on the screen out there. But individual stocks,
while markets are down, there are a lot of individual outperformers as well in today's market. As Nigel also pointed out, few names. The first stock on my list today is Axis Bank. Within the financials, this is one stock which has relatively outperformed the private banking peers. Why so? Because one, there is buying from larger institutions, and B, there was an interesting Morgan Stanley note today morning, and they put out a tactical buy as well on Axis Bank at current levels. So that's the first name. The second stock is CAMS. It's a fresh addition to the F&O list. That stock is under pressure for the last couple of days. So is today as well. The Dow is down 4%. There is selling. It's not a very large liquid stock, but there is selling pressure, and hence you're seeing that stock underperforming. So expect high delivery volumes in that particular name today. The third stock is Minda Corp. Within the broader market names, this is one stock which has not fallen very hard and has been in that very narrow range. But again, for Minda Corp, the indication is that maybe the company is very close to an inorganic move. So that's a trigger there. And the last is Marathon Next Gen. Again, mid-caps company, but hasn't fallen much. It's been in a very narrow range in the last couple of weeks. And now I understand the company is very close to raising funds via QIP. So that's something to watch as far as Marathon Next Gen is concerned.
Thank you very much for that. Slip into a break. On the other side, we'll get chatting with Jigar Mistry from Buoyant Capital. Stay tuned.
Okay, well, now this is approaching the 400-point cut mark on the Nifty. So 360 points, just a free fall through at 23,070 is where now the index is trading at. In the morning I put out supports at the November lows, but that came and went quickly. 263 is that level, and we're at 2370. So just one way kind of a slide. And so many. Actually, I could spend. I could name 30 names which are high liquidity, well traded names which are down 7 to 10%. So just a complete bloodbath. Jigar Mistry is with us, co-founder at Buoyant Capital. Jigar, good to have you here. Thank you for your time. You know, we've seen this, it's not new, right? Every once in a while we do see, it does seem like the world is ending. But the world rarely ends. It goes on. That's a slightly high-level philosophical take on the situation, Jigar. But what is your sense, though? Realistically, pragmatically, markets corrected, broader markets are seeing a fair bit of pain. 5% earnings growth for the Nifty in FY25, and then maybe 12-13% for 26. Those are consensus expectations. The budget is around the corner, so there are potential triggers. Will they actually turn out to be triggers? We don't know. What's your sense?
Hi, Prashant. First of all, thank you as always for inviting me on the show. I would like to believe that a lot of red brings in the philosopher in you, So I'm with you as far as all the philosophical debate goes. But I think, see, if you take a slightly higher level view, then essentially take a 5 or a 10-year rolling return, EPS growth and the share price growth or index level growth across indices, across stocks have always aligned. Today, the large cap is roughly 2 times the returns on the EPS, and the small cap returns are roughly 3 times that of the earnings. If in the longer term they have always aligned, then the fundamental argument has to be that we see the earnings increasing above trend in a material way, or the share prices have to correct. We don't see sort of earnings going up in a hurry, Prashant, because if you look at what's been driving that, which is the capital spending, we are seeing a significant slowdown therein. Right? Consumption of the bottom 40% household has not risen in many years. So the government's way of looking at or tackling this growth problem was to keep spending its way in the hope that they'll crowd in the private sector. In that process, private sector capex has become a lot more responsible after 2015 when the IBC and the other laws were introduced. And the states which were spending, so we did this analysis over the past sort of 12 elections, the state freebie budget, for the lack of a better word, is very similar to its capex budget. So, consumption is not happening in a hurry. Capex used to drive it, but that's slowing down. And share prices have risen way ahead of fundamentals. And therefore, sort of, if we can't argue that the EPS should increase, then the fundamental call has to be that the share prices will correct. How long do they go is a question of debate, but I think directionally we are completely aligned to what the market is pointing at this juncture.
And this whole narrative that liquidity will override and mask weak fundamentals, you don't think that is going to hold in 2025? What makes you say that?
Hi, Rima. So see, you take sort of, say, 2014, the household savings coming into equities was 0.4%. Today, even at a 3 lakh crore inflow, it is just 4%. I know it for a fact that at the peak of the markets in 1992, that number was hovering around 15%. So today, I can make this argument that 2 years out, your sort of nominal GDP will grow, household savings will grow. And even if we approach 10% of that savings coming into equities, then the mutual fund flows can even triple from here. So we're talking of a number of around 9 to 10 lakh crores. My argument against that line of thought is that, we have had multiple narratives over the past 20 odd years. So in early 2000, it was the .com sort of, pets.com raising $182 million. There are companies that were valued at $10 and $100 billion, which effectively went down to zero. 2007 to 9, we had real estate companies in India becoming the largest market cap and richest Indian respectively. 14 to 19, there was this consumption narrative. But despite that, whenever you look at a 10-year rolling return, the EPS growth and the rolling returns have always aligned. Right? So despite whatever narrative, the fundamental fact remains that if we can argue that free cash flows and earnings of an index of a market can rise, only then can we start building in this sort of growth. See, remember, 50% of the mutual fund investors today have come post-COVID. So they've not really seen a 20% drawdown, and how they react in this cycle will determine sort of how deep this cut is what my sense is.
Hi, Jigar. Yes, absolutely. Take your point. Until now, they have been absolutely resilient. They have not wavered. They have not shifted. And that's what the last data tells us, right? The December numbers that we had, where equity funds still got over 41,000 crores of rupees. But yes, I mean, that faith can be put to test, especially for newer investors who have come into the market after COVID. So take your point completely. But let's look at what we can take action on and what we can control. So while the global backdrop settles and the dollar index and tariffs and all those issues are, way beyond us, let's talk about maybe some pockets or examples, if you can name stocks, where you seem to have clear earnings visibility. At least for the next several quarters, there is clear earning visibility, and you're seeing valuations come back into a little more sane zone.
Right, Surabhi. So I think on your point, right, so just before I answer your question, if I have a minute of sort of a latitude, then I'll say that, if you are an investor in the early 2000s, you would have seen close to 6,000 trading days, of which sort of top 10 trading days, which is 0.2% of the number of days, have accounted for 60% of the returns. Right, and top 25 days have accounted for 84% of all returns. So investors who would like to believe that, I'm sitting on the largest cash position of our lifetimes, I feel the conundrum that you would have been sitting on that for a year now, and you would have been right theoretically, but you would have lost money. And therefore, adjusting portfolio beta instead of very large cash call is, I think, the way sort of one can go ahead with this. The last time when I was on your show, about a month and a half back, I would say, we said that if you look at the fundamental dislocation between earnings growth and share price growth, 2 or 3 sectors clearly stand out. Within them, financials is top of the line. They have been sort of a victim of flows, the same way small caps have been a beneficiary of it. FIs could only sell what they owned, and they sold a lot of these financials, and therefore you are getting financials index growth much lower than earnings growth, and accounting for sort of margin squeezing up, NIMs lowering, some asset quality troubles. That index is still, I think, in the prime of health, and therefore that's sort of one pocket which we find very interesting. The second is also healthcare. Right, healthcare, we have argued early 2023 that sort of generics, volumes, and pricing seem to have seen the worst behind, and things could continue to improve thereon. There's a few pockets of stocks that we like, in the small cap space, but I would still say, our small cap exposure is towards the lower end. 2023, we were predominantly exposed to small and mid caps. Today, that number is much lower.
Points taken, Jigar, and very good points that you make. Let's hope that. By the way, just to come back to that first point, how much do stock prices have to fall to align with long-term EPS growth? Long-term returns are about 12%, 25 years, rupee terms. What's
right.
Yeah? What are we looking at?
So rolling returns, Prashant, are 12% earnings growth for Nifty, about 10% earnings growth for small cap. Today, the index is up about 17% for large caps and about 30% for small caps. Small caps, I would say, is better to look at company to companies. But the broader point I was saying is that, so many of us have gotten very used to flows driving the story. And sometimes, most often than not, it doesn't really play out.
All right, Jigar, thank you very much for joining us. Good speaking with you. And, we'll chat again and keep sort of taking stock of things as they continue to play out. Well, we'll take a break. We're back. I think we'll have our technical experts with us, and we'll ask them if there's anything to do as far as trades are concerned. So that is coming right up.
It's been over 2 decades of tracking the global power shifts at the World Economic Forum. Starting from our first story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas to connecting you with the world's visionary thinkers and doers. From decoding blueprints for growth to driving collaboration to make a better future. We've been bringing you a wealth of information through 20 seasons. Tune in to Davos Diaries at Davos 2025, live and exclusive on India's most trusted business news platform, CNBC-TV18.
Welcome back. Holding on to 23,000 but staring at a deep cut of 350 points. Mitesh is now with us for a few BTST calls or STBT calls, if at all. Mitesh, is it just all sell, or are we due for a bounce? How would you approach the last 15 minutes?
Yeah, I don't know whether the bounce will come or not because, I was hoping today it will reverse because it's extremely oversold. You're hitting the earlier highs, but that's not happening. Earlier lows are sold. But, what is good is, and possibly that might work as a some kind of a counterbalancing position is the FMCG pack. I think that's where, you can find stocks doing better. They are holding onto this in this decline. And therefore, HUL might be a good choice to take out BTST against all the short positions that traders are carrying. Keep the stop below 24, 29 and look for a target of around 24, 75, 80, maybe even more depending on how the market kind of gaps up. And on the selling side is Manappuram with a stop at 173.5 for targets of 168.
IT has also been resilient. So TCS is up in the green post their numbers last week. And today all eyes will be on HCLTech and the stock is flat. So expect a good quarter for HCLTech. The street is working with a revenue growth of about 3 to 4%. And the key reason why HCLTech's numbers will be better than peers is because of the products portfolio, which typically does well in Q3. So Q3 of last year, the company had a 6% top-line growth. The year before that, it had a 5% growth. So in a nutshell, Q3 is strong for HCLTech, and hence expect numbers which are better than peers. Margins for the company are also likely to expand to 19.5%, and this is despite absorbing a 2-month wage impact. Profits consequently will be up about 9.5%. But what will excite the street is if the company can raise the upper end of the guided band. So currently, the revenue guidance for HCLTech stands at 3.5% to 5%. There are many estimates which are raising the lower end. So there are estimates from Kotak, which is putting the new guidance at 4.5% to 5%. CLSA is 4 to 5. But what will excite the street is if the upper end of the guidance gets changed from 5% and on an organic basis. The stock has been doing well. It's up close to about 30% in the last 1 year. Anand Tandon is now with us to talk about the market fall. Anand, first your thoughts on the kind of weakness and the painful drawdown that's visible in today's trade.
Well, I think the market has begun to realize that, everything is not hunky-dory either globally or in the domestic market. Clearly, the slowdown is beginning to have its effect. The numbers in terms of earnings are not very supportive. And the one thing that everything was kind of anchored on, that the government spend will raise demand domestically, has been slow to take off. And globally as well, the fact that the dollar has strengthened means that the expected movement towards emerging markets has not only not happened, but has actually reversed. And as a consequence, we are seeing this fall across most markets. I would expect that this trend will continue for a little while longer before we see any meaningful reversal.
Okay, well, no signs of any meaningful reversal today for sure. The market continues to reel under pressure, 340 points lower. Anand, hi. Good afternoon. Good to have you on. I mean, the only little speck of green we're seeing today, once again, is IT and healthcare and pharma. IT, I guess TCS gave some hope with its slightly positive commentary. Would you look at either of these sectors? Do you like any specific stocks here? If you could name them, please. IT or pharma, if you think they offer some sort of relative safety.
So they offer safety, Ruby, only because of the fact that they're dollar denominated. Therefore, you expect to see earnings growth happening a little more than what they would estimate. The earnings growth remains extremely anemic, no matter whatever the TCS numbers guidance may have shown. The reality is that you're still looking at very, very low kind of earnings growth compared to where the valuations are. These stocks are expensive, make no mistake. When you're trading at 30 times forward earnings with an earnings which is trading at 10, 12, at the very best for the rest of the companies, percent increase, there is no rationale for buying these stocks. You look at the US market, you will find the best of the stocks trading at with valuations which are lower than that, perhaps with better earnings growth. So from an Indian market perspective, two things have happened. One is that the IT till recently was not a very well-owned sector, and therefore, keep some upside. Same thing goes with pharma. Again, because of the fact that you're looking at the export market, those are also going to be indexed on the dollar movement. But otherwise, if you look at even the best of the lot, which is, for example, Dr. Reddy's, the fact is that their earnings after 2 years will at best be where they are today because of the fact that they have had a sharp jump because of one drug. So you're not really looking at earnings growth driving any of this. In fact, at all, if you want to look at companies which are likely to provide you some kind of sustenance, would be FMCG in my view, simply because they haven't moved, so nobody owns them. And as a consequence, they are unlikely to be sold into. And, you could argue that if the domestic demand in rural India picks up, then some of that will rub off. But again, the numbers are not very attractive from an earnings versus valuation perspective. But nobody owns them technically, therefore they are a reasonable place to be.
Underperformers, that's FMCG for you. So perhaps that's one area to look at in the fall. Do stay on, Anand. We need to slip into a very short break. We'll come back with more market talk.
sailing, I believe. Yeah. So, talk about all the lessons and all of that. Are we on the cusp of a breakout moment for the experience economy in India?
It's like the analogy from Formula One. So the car that's in front of you is cutting through and creating the slipstream and using more power and energy.
Yeah.
And the guy who's behind you is using 25% less. And he can press the DRS and get ahead of you.
Yes.
We live in 4 Indias. We live in the London of India, which is about 5 million people. And then there's about 50 to 60 million Indians, which I call the United Kingdom of India. Then there's 400 million Indians, which I call the Brazil of India. And then you've got about 300 to 350 million Indians, which I call the Africa of India.
Let's address the issue that you've been dealing with in the last few months on account of what's happened with Coldplay. You've got investigative agencies, you've got the EOW, you've got the GST authorities.
I've got a clean conscience. My karma is good. I sleep well.
Welcome back. It's been a crunching day for the market. And earlier in the morning, we were in conversation with Sanjay Mukim, who is the strategist and head of India Equity Research at JP Morgan. Mukim says that he's not expecting any major stimulus from the government in this budget, given the fiscal constraints. Listen in.
So Q3, we expect single-digit earnings growth, but for 25, we think we'll get around 10-11% EPS. When I say CY25, it's effectively FY26. I think we haven't gotten as far as forecasting FY27 yet. But we like real estate, we like the power sector, we like financials structurally because, look, that's the one space where you get a combination of decent valuations and hopefully good long-term dynamics. We currently are underweight materials and some select consumerish names, perhaps. But I think, look, if you try and say that, look, this correction is providing me opportunity, that's effectively a call on valuations, right? Where have valuations become reasonable? And if you use that filter, unfortunately, it's only the financials that pop up even today. Let's not expect any major sort of stimulus, because my guess is the government will want to stay on its path of fiscal consolidation. And if not fully to 4.5, they would want to bring deficits down a little bit further in the next budget as well. But do we see an environment where the RBI brings in too much of surplus liquidity? Probably not just yet.
Okay, that's the JP Morgan view. I'm just opening up the list of losers, that very red-looking screen right now, to see the worst hits. Macrotech developers, 9%, PB Fintech, 9%, Mazgaon Dock about 8 to 9%. It's just such a long list. AB Real Estate, Just Dial is down 13% now, by the way. It's a long list. Anand, let me ask you. So, buying anything? I mean, some of these stocks, I'm sure you have fundamental reasons to look at the companies optimistically. Is there any match anywhere where there seems to be reasonable earnings visibility and not very bad valuations?
Like everybody's been saying, the only place where you can argue on the basis of valuations is the financials. And even within the financials, I think you have to take a hard look at those which are consumer oriented, because that's going to be a difficult place to play. So you are actually looking at either industrial growth, which has yet to happen, but more importantly, you are looking at things which are more on the asset side than on the liability side. So things like insurance, perhaps, is something that I would still think have some way to go. Some of the private sector banks, again, because of the fact that they can raise liabilities lower. Look, the basic issue is that the whole construct of the market was interest rates have peaked out and they will fall. That is now turned on its head. There is no question of interest rates falling. If at all there is a possibility, they may have to raise it further, failing which we will have a problem with the forex rate that we have. And again, the second question of consolidation, I don't see the consolidation. Please look at the gross numbers between the state and the center, and the number doesn't fall at all. I mean, marginally falls here and there, but it's not substantial. So you don't really have the fiscal bandwidth to be able to continue to push beyond a point. So there has to be domestic growth which is coming out of the private sector, and that's not happening when you're going to tax popcorn.
Okay. Well, that's, I guess, a wider debate that the GST Council was preoccupied with in the previous meeting. Got that. But, just to look at some of the other, key movers and shakers. Actually, it's only 2 minutes to go before the close. So, Anand, just allow us a few minutes. We'll close down the market and then come back to you for some more perspective. The picture hasn't really changed. It is still very much a large 350 points sort of a fall. I don't know if maybe the adjusted close will mean that we managed to close above 23,100, but it's just below that mark right now as we speak, and a 4% decline on the midcap index. 2,200 points gone, 2,200 points gone from the midcap arena as well, the midcap index that is. Okay, so let's talk about the weakest names on the large cap screen first. Adani Enterprises, Trent, obviously BPCL, HPCL, IOC, the oil refining companies have taken a huge knock today on this big 5% surge in oil prices. There are other PSU names as well, BEL, Power Grid, NTPC, ONGC as well. You'd imagine that the upstream players would see a sentiment uptick, but not so. It was not even that today. So fair amount of weakness coming through. The green only is partially in some tech names like TCS. There's some buying on an Axis Bank and a Lever and IndusInd Bank because of the expectations of more flows. There's a technical adjustment happening there because of the FPI ownership. But otherwise, deep sea of red in large caps, that's not even the real story, Prashant. I guess the real story is the pain in the mid caps today.
Absolutely. And, 10-1 declines to advances today, and just smackdown and hard. Kalyan Jewelers continues to sell off. I think it's fallen some 30% very quickly from the highs.